Chapter 3. A Century of Stock Market History. The level of stock prices in early 1972. The investor portfolio of common stock will represent a small cross-section of that immense and formidable institution known as the stock market. Prudence suggests that you have an adequate idea of stock market history, in terms particularly of the major fluctuation in price level and of the varying relationship between stock prices as a whole and their earning and dividends. With this background, you may be in position to form some worthwhile judgment of the attractiveness or danger of the level of the market as it presents itself at different times. By coincidence, useful statistical data on prices, earning, and dividends go back just 100 years to 1871. The material is not nearly as full or dependable in the first half period as in the second, but it will serve in this chapter. We shall present the figure in highly condensed form with two objects in view. The first to show is to show the general manners in which stock have made their underlying advance through the many cycles of the past century. The second is to view the picture in terms of the successive 10 years of average, not only of stock prices, but of earning and dividend as well, to bring out the varying relationship between the three important factors. With this wealth of material as a background, we shall pass to consideration of the level stock prices at the beginning of 1972. The long-term history of stock market is summarized in two tables in chart. Table 321 set forth the low high points of 19 bears and the bull market cycle in the past 100 years. We have used two indexes here. The first represents a combination of an early study by the Cowles Commission going back to 1870, which has been spices to and continue to date it in a well known Standard and Poor's Complexities Index of 500 stock. The second is even more celebrated Dow Jones Industry Average, the DJIA, or the Dow, which is dated back to 1897. It contained 30 companies, or which is American Telephone and Telegraph, and the other 29 large industry enterprises. Part 1 represented by the courtesy of Standard and Poor's. Despite the market inflation of its 425 industrial stock index from 19,000 through 1970, a corresponding chart available for the DJIA will look very much the same. The reader will note three quite distinct patterns, each covering about a third of 70 years. The first run from 19,000 to 1924 and show the most part of the series rather similar market cycle, lasting from 3 to 5 years. The annual advance in this period averages about 3%. We move on to the new era bull market, culminating in 1929 with its terrible aftermath of collapse, followed by quite irregular fluctuation until 1949. Comparing the average level of 1949 with the 1924, we find the annual rate of advance to be mere 1.5%. Hence, the close of our second period found the public with no enthusiasm at all for the common stock, but the rule opposite in the times ripe for the beginning of the greatest bull market in history, presented in the last third of our chart. This phenomenon may have reached its consummation in December 1968 at 118 for standard imports, 425 industrial, and 101 108 for its 500 stock composition. As Table 321 show, the fairly important setback between 1949 and 1968, especially in the 1956 to 1957 and 1961 to 1962, where the recoveries therefore accepted semantics as realization in a single bull market rather than the separate market cycle between the low level of 162 for the Dow in mid 1949 and the high of 995. In early 1966, the advance had been more than sixfold in 17 years, which is at the average compound rate of 11% per year, not counting dividends of, say, 3.5% per annum. The advance of the Standard and Poor's Composition Index was somewhat greater than that of the DJIA, actually from the 14 to 96. These 14% and better return were documented in 1963 and later in much public study. It created natural satisfaction. So this is the table. On Wall Street, with such fine what achievement and a quite illogical and dangerous conviction, the equally marvelous result could be expected for common stock in the future, for people seem to have been bothered by the thought that the very extent of the race might indicate that it had been overdone. The subsequent decline from the 1968 high to the 1970 low was 36% from the Standard and Poor Company composition, and 37% from the DJIA, the largest since the 44% suffered in the 1939 to 1942, which has reflected the perils and uncertainties after Pearl Harbor, and the dramatic manner so courageous of Wall Street. The low of May 1970 was followed by the massive and speedy recovery of both average and the establishment of the new all-time high for the Standard and Poor industry in the early 1972. The annual rate for the price advanced about between the 1949 and 1970, worked out at about 9% of the S&P composition, or the industrial index, using the average figure for both years. The rate of climb was of course much greater than any similar period before 1950, but in the last decade the rate of advance was much lower, 1/4% of the S&P Composition Index, and only once familiar 30% of the DJIA. The record price movement should be supplemented by the corresponding figure for earning and dividends in order to provide an overall view of what has happened to our share economy over 10 decades. We present a complexion of this kind in our table. 32, page 71. It's a good deal, but expect the reader that he study all these figures with care. But for somehow they will be interesting and instructive. Let us comment on them as follow. The full decade figures smooth out of year-to-year fluctuation and leave a general picture of the percent growth. Only 9 decades after the show of decrease in earning and average prices at 1891 to 19,000 and 1931 to 1940, and no decade after 19,000 showed decrease in average dividends. The rate of growth in all those categories are quite variable. In general, the performance since World War II has been superior of the earlier decades, but the advance has been 1960s was less pronounced than that of the 1950s. Today, investors I cannot tell from this record that the percentage gain in earning dividends and pricing may expect in the next 10 years, but it does supply all the encouragement he need for constant policy of common stock investment. However, a point showing made here that it's not disclosed in our table. This year, the year 1970, was marked by definite deterioration in the overall earning by poster of a corporation. The rate of the profit on invested capital fell to the lowest percentage since the World War years. Equally striking in fact, a considerable number of companies reported net losses for the year. Many became financially troubled, and for the first time in 3 decades, there were quite a few important bankruptcy proceedings. These facts, as much as other have prompted the statement have made above, that Great Born era may have come to an end in 1969 to 1970. A striking feature of Table 322 is the change of the price-earning ratio since World War II. In June 1949, the S&P Composition Index sold at only 6.3 times the application earning of the past 12 months or the past 1 year. In March 1961, the ratio was 22.9 times. Similarly, the dividends yield on the S&P index had fallen from the 7% in the 1949 to only 3.1% in the 1961. A contrast heightened by the fact that the interest rate on the highest grade bond had been meanwhile rising from 2.600% to the 450% of this. Certainly the most remarkable turnabouts in the public attitude in all stock market history. The people of long experience and into caution the passage from one extreme to another carried strong warning of trouble ahead. They could not help thinking apprehensively of the 1929, 26, and 1929 bull market and its tragic aftermath, but these fears have not confirmed by the event. True, the closing price of the GIA in 1970 was the same as 6.5 years earlier, and the much heralded soaring 60s proved to be mainly a march up the series high heels and then down. But nothing has happened either to business or to stock price then compared with the bear market and depression of 1929 to 1932.